The chapters in the course notes have several learning outcome statements. Those indicate what you are supposed to be able to do when we finish covering that chapter. For Chapter 1, there are 3 learning outcome statements. The first one is to compare the various forms of business enterprise and place particular emphasis on the corporation. The second one is to identify the goal of the financial manager. Since the whole course is built on the satisfaction or achievement of that goal, we need to know what the goal is for the financial manager of a corporation. And the third goal is to understand financial markets and why they exist, some of the participants and what they do in those financial markets. So the notes in Chapter 1 are broken down underneath those various learning outcome statements. Again, other chapters are organized similarly. If you don't want to watch the whole chapter at one time, perhaps you should watch an entire learning outcome statement at once and then do any practice problems for that particular learning outcome statement before you move on to the next one. Here are some handy tips that will help you as you study each chapter throughout the semester. You should work the examples in the rectangular boxes found throughout most of the chapters one of 2 ways. Either pause the lecture as you go along and work those practice problems in the rectangular boxes as you go, or you may choose to watch the entire chapter lecture and then work those practice problems in the rectangular boxes after you've completed the chapter, possibly even a day or 2 later to refresh your memory on what was covered. And the answers to those practice problems in the rectangular boxes are found at the end of the chapter within the course notes. So the solutions to all the examples in the rectangular boxes are actually in the course notes themselves. You should work the supplemental homework practice problems that are found at the end of most of the chapters. The solutions to those can be found one of 2 ways. I actually work them using the document camera, and the solutions are posted to iTunes U, so you can watch me actually work them out and discuss them as I go on the recordings posted to iTunes U. Or if you just want to see the final answer, there is a PowerPoint file posted to Blackboard that will give you the final answer to those supplemental homework practice problems. These are of critical importance. You should work them on your own before you check the answers to those. By doing so, you can correct any mistakes you might have made. Certainly look at the answers, but I encourage you to work them on your own before you check the answers. There will be a Connect assignment that covers the material for every chapter. You should check the syllabus for the due date of the Connect assignments and what chapters it covers. Some Connect assignments cover more than one chapter, so check the syllabus for the due date of the Connect assignments and what chapters are covered on those Connect assignments. For the exams, you should check the syllabus for the date, time, place, and the chapters covered for each exam, and you should begin studying early. We allow you to use a half sheet of notes on the exams, and you should start preparing that early. For the final exam, we'll give you a specific sheet that you'll need to use, but for the other exams during the course, you can use a half sheet of notes as indicated on the syllabus. Chapter 1 provides an introduction to corporate finance. The 3 learning outcome statements in Chapter 1 are to compare the various forms of business enterprise, placing specific emphasis on the corporation, identify the goal of the financial manager of a firm, and to understand financial markets and why they exist. We'll start with the sole proprietorship, which is a business owned by an individual. On page 4 of the course notes, you'll find the blank for individual that you need to fill in, and then the discussion below that, explaining some of the advantages and disadvantages of a sole proprietorship. If we start with the advantages, one is that it's virtually costless to form a sole proprietorship. One merely needs to go into business by, quote, hanging out a shingle with their name on it and providing a good or a service. Another advantage is that taxation is relatively simple because the owner reports their business income on their own personal tax return, so the proprietorship itself does not pay any taxes. The proprietor pays taxes. And what's often considered a benefit is that the owner retains all the profits and makes all the decisions. Of course, there's an element of risk and some responsibility there as well, but a lot of people consider it a benefit to be their own boss and to be in charge. Disadvantages are that it's not possible to specialize if you are the only manager, the only employee sometimes. And when the owner dies, the proprietorship dies with them. It's also difficult to transfer ownership because basically the business dies with the owner when it's a proprietorship. And a proprietorship is often difficult to finance because the ability to raise capital is limited to what the owner can contribute or borrow in their own name. In other words, basically go borrow as Kent Reagan, not borrow in the company name, because the proprietorship and the proprietor, the owner, are one and the same legal entity. A major disadvantage for a proprietorship is the idea of unlimited liability, that if something goes wrong in the business, the owner, proprietor, can lose not only their business assets or investment in the business, but their personal assets are at risk as well. So if someone makes a defective product doing business as a proprietor, and that product is defective, and someone sues the proprietor and the proprietorship, since they're one and the same, then they might be able to seize the business assets, but they might be able to also seize the owner's personal assets as well. So that's known as unlimited liability. The second legal form is a partnership. A partnership is where two or more persons organize a business for profit. It takes two or more to have a partnership because you need a partner. Advantages are very similar to those of a proprietorship because it's easy to form. But also keep in mind that it's recommended you have a written partnership agreement if you're going to have a partnership that spells out what each partner will contribute as far as time and investment, what their duties and responsibilities are, how the partnership will be taxed, how the assets will be split up if the partnership is dissolved, and other matters such as that. Again, taxation, similar to a proprietorship, taxation is fairly simple because the partnership does not pay taxes itself. Each partner gets a K-1 form from the partnership showing them their share of the income, and they report their income and pay taxes from their partnership profits on their own individual tax return. So there's no partnership taxes paid. The partners pay taxes on their portion of the earnings on their personal tax return. Now that there is more than one partner, there might be some ability to share responsibilities or to specialize a little bit more than under a proprietorship, but again, partnerships don't do that quite as well as we'll see corporations are able to do. Disadvantages of partnerships are, again, it's difficult to transfer ownership because when one partner retires, sells out, or dies, the partnership essentially has to be reformed, creating a new partnership. Therefore, it's recommended there be a buy-sell agreement that spells out what happens upon retirement of one partner and how their interest could be valued and how it would be bought out by the other partners or the heirs of a deceased partner. Capital is financing, and partnerships still have limited ability to raise capital, partially because there is unlimited liability that extends to all the partners in a partnership. In fact, the unlimited liability aspect of a partnership can be even potentially worse than that of a proprietorship. That's because each partner is said to have joint and several liability for all the debts of the partnership. In this case, several does not mean many or multiple. It means sever, to cut away. So let me explain that. Jointly, the partners have liability. So if a partnership produces a defective product and someone sues and say they win a $1 million judgment, then perhaps each partner could be responsible together for the $1 million judgment. Jointly, we might get the impression they each would be liable for half of the $1 million, or $500,000 apiece. However, one partner could be cut away from the partnership if they have the deeper pockets, they have more assets than other partners. The folks who are owed the $1 million could come after that one partner and seek the entire judgment from them. So the partner with the deeper pockets might end up paying more of that liability. Now, not every partnership suffers from unlimited liability for all partners. A limited partnership limits the liability of so-called limited partners to their investment. They're simply investors. They can lose their investment but not their personal assets. However, at least one general partner must face unlimited liability. Somebody has to have ultimate responsibility for the debts or liabilities of the partnership. In order to have limited liability, those limited partners must not actively participate in the management of the partnership and are deemed to be silent partners, or the limited partners are merely investors. Now, corporations, which will be our focus for the entire course, are a separate legal entity, separate from their owners. Now, the corporation has the ability legally to do things that people can do, such as buy and sell property, own property, sue and be sued, and of course has a legal obligation to pay taxes just like individuals do. The ownership of a corporation is evidenced by shares of stock, so we have the stockholders who are the ultimate owners of the corporation. We start to see some distinct advantages that corporations have over and above the other forms of legal enterprise we have talked about. One is that the owners and those who control the corporation, the management, are often not the same. We have the separation of the ownership, the stockholders, and the day-to-day control, management. So if you think about a corporation as being a separate legal entity, somebody can invest in the company by purchasing stock, and they don't have to take an active role in the management of the corporation. They simply buy a piece of the action by purchasing stock and then leave it to management to run the corporation on a day-to-day basis. This allows for specialization of management. We could have a diverse ownership, a bunch of stockholders who elect a board of directors who hires managers in the different functional areas such as accounting, finance, marketing, the management function, management information systems, project managers, and things like that. The stock form of ownership also provides for the transfer of ownership. Transfer of ownership is relatively easy for a publicly traded corporation because you can just sell your stock if you no longer want to own it, or if you want to own more stock, you simply purchase more stock. If it's a non-publicly traded corporation like a closely held or a family-owned corporation, then transfer can be a little more difficult, but a corporate form does allow for diverse ownership through ownership of shares. The separate legal entity nature of a corporation allows it to survive the owners. It can continue on even though one owner may die, their stock might go into their estate or go to their heirs, the corporation would continue. Arguably, one of the largest, most important benefits of the corporation is the idea of limited liability. Owners can lose their investment, their stock price can go to zero and become worthless, but they will only lose their investment. Their personal assets are not at risk for a corporate shareholder, so they'll lose nothing more than their stock value in a corporation. Limited liability limits their loss or their risk to their stock investment, not their personal assets. Disadvantages of corporations include that there is some legal red tape necessary to organize and maintain the corporation, such as filing articles of incorporation, paying necessary fees, and things like that. Potentially a financial disadvantage is the double taxation. Dividends paid by corporations are not tax deductible, but they are taxable to the shareholders who receive them. So that historically has been potentially a significant disadvantage to the corporate form. It's been relaxed somewhat more recently, but it is subject to change. Of course, Congress changes the tax laws from time to time. This is a potential disadvantage one should be aware of. For small family-owned corporations, typically, there's a possibility to overcome the double taxation by making what is called a sub-S or an S-corp election, where the corporation is taxed as a partnership. So each partner receives a K-1 form. Each shareholder receives a K-1 form just like the owners would in a partnership. So for an S-corp, the shareholders are taxed on their share of income on their personal tax return, and the S-corp itself does not file a tax return and pay taxes. It just reports the shareholders' share of the gains and losses to the IRS, and those taxes are paid at the shareholder level. The fourth form is a limited liability company, which is a more recent innovation than the other forms, and this allows firms to choose whether to be taxed as partnerships or taxed as corporations. And as the name implies, they limit the liability to the investment just like corporate shareholders have limited liability, but their tax treatment is more flexible. Now, the example on double taxation is example 1.1. This arises because dividends paid are not tax deductible. So corporations generate taxable income, they pay taxes on their taxable income, and they end up with some net income. If a portion of that net income is paid out to shareholders in the form of dividends, there is no tax deduction for the corporation, and then the shareholders may be taxed on those dividends, and that is called the double tax. The corporation was taxed on its taxable income, and then shareholders can be taxed on the dividend income. So double taxation is something to be aware of. Dividends paid are not tax deductible. Dividends received are taxable to some extent. In this example, we have initially a proprietorship with a 35% tax bracket, and then later we have a corporation where the shareholders and the corporation each face a 35% tax bracket. We'll start out with a taxable income of $1 million for the proprietorship, taxed at a 35% rate. So for the proprietor, they would pay $350,000 in taxes on their $1 million of taxable income. That would leave the proprietor with $650,000 after those taxes are paid on their $1 million of taxable income. Now, if this same firm did business as a corporation and had $1 million of taxable income, then since the corporation is a separate taxable entity, we're not dealing with an S corp here. We're dealing with a regular C corporation where it is a separate tax-paying entity. Then the corporation would send $350,000 to the IRS, and the corporation will be left with $650,000 after taxes. So far, that's the same as the proprietorship. But the goal is not to leave the $650,000 inside the corporation. Ultimately, the goal is for those earnings to be received by the owners, the shareholders. So we'll assume the entire $650,000 is paid out to those shareholders as dividends. And we'll assume, and this is not currently true, but we'll assume those dividends are fully taxable. And this dividend income received by the shareholders of $650,000 will be fully taxed. And our assumption was both the shareholders and the corporation face the 35% tax bracket. So when the $650,000 of dividends are received by the shareholders, they will also be taxed at 35%. So the personal taxes are $227,500. The shareholders received $650,000 in dividends, pay taxes of $227,500, and they're left with $422,500. Remember, when it was a proprietorship, the proprietor was left with $650,000. Now, as a corporate shareholder, because of the double taxation, they're left with only $422,000 after taxes. Now, again, while it's true dividends paid are never tax deductible, sometimes not all dividend income is taxed. Here we have assumed two things. One, the dividends are fully taxed and that the shareholders have a 35% tax rate, as did the corporation. Okay, so those rates are not always the same, and dividends are not always fully taxable. But one thing you can pretty much count on is dividends paid are never going to result in a tax deduction for the corporation paying those dividends. And that's what gives rise to the double tax. Now here's something to think about. About 80% of sales volume is made by corporations. But if we were to count the business enterprises that exist, we'll find that corporations only make up about 20%. So what does that tell us? Well, it would tell us that a lot of small businesses, people who provide a service from their home or produce small products, handcraft things, those tend to be proprietorships. A lot of large companies, the household name companies, tend to be corporations because the way they became large was because they had incorporated. They wanted to expand, and they find the possibilities of expansion are much greater if they incorporate and they seek capital from a large number of investors. The corporate vehicle, the business form of a corporation, enhances the ability to seek capital by issuing stock to a bunch of owners who have limited liability. That knowledge that they can buy the stock and not be risking their personal assets, but only be risking the amount of money they put in their stock investment, is what will sometimes entice somebody to buy stock in a corporation where they would never dream of investing into a partnership or doing business in some other form. So the corporate form provides ability to raise capital through issuing stock, and the likelihood of getting stockholders is enhanced greatly by being able to provide them with limited liability. Now, let's think about what the financial manager of a firm should be doing. The financial manager works for the shareholders. Thus, they should always keep that in mind and work for the shareholders' benefit. The goal of the financial manager, while often thought to be profit maximization, is actually a little different from that. Let's think about if we had profit maximization as our goal, why that might not be optimal. Okay. One is that profits are vague. Are we talking about maximizing profits over the next year, or the next 5 years, or the next 25 years? And it's also the case that profit is simply typically the net income number from the income statement. And the profit or net income that a firm generates could be subject to some degree to manipulation by management, such as in thinking about how to cost their inventory under FIFO or LIFO, or how long the useful life is of an asset, whether something should be expensed immediately or capitalized and have their expenses spread out over a number of years. So it's that ability to perhaps manipulate, or at least the involvement of judgment in the preparation of financial statements, that could cause profits to not be an absolutely reliable measure and may not be the appropriate goal for the firm. In finance, we ascribe to the theory that the maximization of shareholder wealth should be the goal of the financial manager. Since the financial manager works for the shareholders and they have some ability to influence the stock price, then they should work to maximize that stock price, and that will help maximize the wealth of the shareholders that the managers work for. Also, since stock price is determined in financial markets with a lot of buyers and sellers interacting, and certainly regulation in the financial markets, then hopefully the market prices are not subject to managerial manipulation. The buyers and sellers in the financial markets come together to set the stock price. If the financial manager will make good decisions and do things to positively impact that stock price, then that will benefit the shareholders and maximize their wealth, which is the goal of the financial manager. Now, a basic understanding of financial markets will help set the tone for the rest of the semester. Financial markets include all the institutions and procedures that facilitate transactions in all types of financial claims. So we're talking about stock exchanges and commercial banks and brokerage houses and the stock investor themselves, whether individually or large institutional investors. All these players come together to establish the financial markets. And the primary function of a financial market is simply to transfer savings from those who have it to those who need the savings. Financial markets exist to move savings from those who have it to those who need it. In other words, the financing, the savings or financing sources end up where it is the most needed. So the households who generate their earnings by doing their job and getting a paycheck, hopefully pay their mortgage and pay for their car and pay their other expenses, and hopefully they'll accumulate savings. And as the households accumulate savings, they can invest those savings by depositing it in the bank, purchasing stock, purchasing bonds, or purchasing some other financial asset. So as the households purchase these financial assets that are issued by businesses, then they are providing the savings to the demanders of the savings, which are the businesses. In other words, households want to save and invest for the future. Businesses want to expand, build new factories, buy new equipment, add additional inventory and things like that, and that requires financing. So the businesses depend upon the households to save and invest in the businesses so the businesses can expand, employ resources, put people to work, generate earnings on down the road, and provide a return back to the households in the form of interest on debt or dividends on stock. In financial markets, we have real assets that are tangible, physical assets like plant and equipment, land, inventory, and things like that. And we also have financial assets. Financial assets are paper assets. Basically, they are legal claims on the earnings or the payments that will be generated by the real assets. So financial assets are claims on real assets. If we did not have financial assets, then transactions would have to take place in real or physical assets. In other words, without financial assets, trade would be in the form of barter, trading one good or service for another good or service. Financial assets make it much easier to break down the ownership of physical assets and trade only portions of the ownership of physical assets. In other words, if we formed a corporation that bought a plant building, there could be 100 of us who each own 1% of the corporation that owns that plant building. Indirectly, we would each own 1% of the plant building, but the corporation could sell the plant in whole, or I could sell just my 1% ownership by selling my stock. So the financial assets make it much easier to transact in portions of those real or physical assets. Trading of securities starts in the primary market, where the securities are created for the first time and sold to their initial investors. The investment bankers, or the go-between, a financial intermediary, are the firms that help corporations create new financial assets and get them in the hands of those initial investors. So the investment bankers work in the primary markets to help corporations raise capital by issuing new stock or new debt to the first investors. After that primary market transaction, then stocks, other securities, can trade from investor to investor to investor in what we call the secondary market. There's no limit to the number of times a security can change hands in the secondary market as it trades from investor to investor to investor. Trading takes place either on organized security exchanges that occupy a physical location, with brokers matching the buy and sell orders for the investors. In other words, a broker is someone who does not actually own the security, so they don't buy and they don't sell the security necessarily. They are just helping match a buyer with someone who's willing to sell and to facilitate the transaction. If not on an organized exchange, trading takes place on what is called the over-the-counter market. These are the dealer markets. Organized security exchanges are where brokers bring buyers and sellers together. The dealer markets are where the dealers are actually involved. They actually take one side of the trade or the other. If you buy a security in a dealer market, or in the over-the-counter market, you are buying the security from the securities dealer. That dealer must have purchased it from some other investor or the issuing firm at some earlier point in time when they were a buyer, and now they are a seller and they're willing to sell it to you. Of course, they wanted to buy low and sell high and make a markup in selling you that security, versus the brokers who work on a commission or some sort of fee structure, making their money through the volume of transactions instead of actually buying, marking up, and reselling the security. In order for a firm to be traded on a particular stock exchange, the stock has to be listed on the exchange. The firm pays a fee to the exchange for the benefit or privilege of being listed. For the New York Stock Exchange, it has the most stringent listing requirements. For example, there have to be at least 1.1 million shares for a firm to be listed on the New York Stock Exchange. There are other requirements as well. Basically, the NYSE wants to know that a firm has a sufficiently diverse ownership so that there will be trading in the stock of that firm, because while the firm does pay listing fees, the exchange also receives compensation when trades take place in that stock. So the exchange wants to see a lot of different ownership, so there are a lot of transactions in the stock. Now here's a question to think about. How many primary market transactions are there for a given security? Of course, the primary market was where the investment bankers help the issuing firms issue securities to the initial investors, and that creates the security, and that can only happen one time for a given security. Primary means first. The security can only trade for the first time once. Would the issuing firm ever be a party to a secondary market transaction? We know the issuing firm issues a new security in the primary market. Would the issuing firm ever be a party to a secondary market transaction? Sure, if they repurchase their stock on the open market, then they go through the exchange to buy their own stock back from investors in what's known as a share repurchase. Is the New York Stock Exchange a primary or a secondary market? Well, it is actually investors trading with other investors in the New York Stock Exchange listed stocks. So those are secondary market transactions. It's not investment bankers facilitating the issuance of new securities. It's trading of stock from investor to investor to investor in the secondary market. And that the New York Stock Exchange is one example of a secondary market. Now the final topic in Chapter 1 is the agency problem. This arises because the managers and the owners of a firm may not be the same, and that's commonplace in the large publicly traded corporations. The stockholders can be very numerous, and they own the stock. The managers work for those shareholders, but they're often not the same as the shareholders. The managers are supposed to work for the stockholders and pursue goals, carry out business that's in the best interest of those stockholders, but not every manager always behaves in exactly that fashion. The agency problem exists because the owners, stockholders, or the principals are not the same as their managers, who are the agents of the stockholders. Potential costs that a corporation would incur because of this agency problem would include some direct costs, such as perquisites or perks, where a manager might spend corporate resources for their own gratification, such as remodeling their office or flying on the corporate jet when they could fly coach, and also the necessity of auditing the firm because the owners and the managers are not one and the same. There are also indirect costs that exist whenever the owners and the managers are different people. One example is lost opportunity that comes from managers potentially being overly conservative. A manager might believe that they personally will benefit from making decisions that have low risk. But low risk often equals low return. So an example is that a shareholder might benefit from a higher return if the corporation takes on somewhat riskier investments. But a manager might see a risky investment as a greater probability of failure, for a project to fail or cost the shareholders money. So while a manager might see a potentially good investment the corporation could make, it might be riskier than other possible investments. It might be expected to produce a higher return, but it also has higher risk. So if the manager encourages the corporation, the board, to pursue a risky alternative, and that alternative fails and costs the shareholders money, that manager might be fired. So they might be only willing to take on low risk, produce a low return, and the shareholders could suffer from that overly conservative approach. So that's an indirect cost of the owners and managers not being the same. Not willing to take on risk because one might suffer personally from investments that don't pay off. There are incentives put in place that will encourage managers to act in the interest of shareholders. One example is quite common where managers receive stock options, and those stock options have more value as the stock price goes up. So a manager may have a couple of years to purchase stock at $50 per share. It's currently selling for $45 per share in the market. Immediately that's no benefit, but they have the option to purchase it at 50. So if the stock price goes to 55 or 60, they have the option to purchase for 50, then you can see that that becomes a distinct benefit when the stock price moves to $55 or $60. The manager can buy it for $50, then they would have a personal financial incentive to get the stock price to move higher because they have that stock option, the right to buy it at a set price. Another incentive to be a good manager and make good decisions that will benefit the shareholders is that the better performers will get promoted into higher positions of authority, higher pay scale, and things like that. So we do have personal incentives to perform well sometimes when our potential for promotion and higher pay comes as a result of our good decisions. Another issue to think about is if managers are not performing well, then their stock price is probably not going to perform well, and they will not be in the managerial positions for very long because there could be some fight to take over the firm. That can take place in form of what's called a proxy fight, where people try to get proxy or the right to vote someone else's shares so that they could then elect a new board and take over the firm, or the outright purchase of shares, such as a hostile takeover where they actually buy enough shares to get enough votes to put in the board they want to. So if you're not doing your job, ultimately you might lose your job because somebody might get put in your place, or the board might get voted out because somebody else might take over the firm. Now let's do the concept review for Chapter 1. This may not cover every concept, but it will review some of the most significant concepts, and will encourage you to review the others on your own. What I would recommend is that you pause the lecture at this point and try to fill in the blanks with what you think I might have been thinking when I wrote those, and then I'll go through the solutions to show you what I was thinking at this point. The first concept review question for Chapter 1 deals with limited liability. The shareholders of a firm are said to have limited liability because that means their losses are limited to the amount of their investment in the firm, what they paid for their stock, nothing more than that, because they're not personally liable for the debts of the business enterprise. Limited liability exists for the shareholders of corporations, for limited partners, but not general partners, limited partners in the limited partnerships, and the owners of limited liability companies. All of those have their investment limited, have their potential loss or liability limited to their investment in the firm. Their personal assets beyond that are not at risk. While most firms are proprietorships because all you have to do is go into a business, sell something from your home, or make a product and sell it to be a proprietor, most large firms are corporations. One possible reason is because the ownership of the corporation can be separate from the management. Limited liability makes that possible. Somebody might be willing to be an owner or a shareholder and not be involved in the day-to-day management of the firm if their liability is simply limited to their investment in the stock. Another reason why most large firms tend to be corporations is because they have the ability to raise capital by issuing stock. And of course, the additional liquidity of being able to sell their stock on the stock market might cause other people to be willing to be stockholders in a corporation when they're not willing to invest in some other type of business enterprise, because publicly traded stock can be sold fairly easily. A corporation is a separate legal entity, so it files its own tax return, while the owners of a proprietorship or partnership will include the taxable income from their businesses on their personal tax return. So the corporation gives rise to the double tax because the corporation is taxed and then the stockholders are taxed on the dividends, but a proprietor or a partner is only taxed one time at the personal level because they pay the taxes on their business income on their personal tax return. So the double tax is a disadvantage to corporations, particularly the traditional C corporations, because those are separate taxable entities. They file their own tax return, and then the shareholders are taxed on the dividends they receive. We say that the corporation does not deduct the dividends it pays because those dividends are paid out of after-tax dollars. So when a corporation computes its taxable income and computes its taxes and arrives at net income, then if the corporation pays dividends, its taxable income is not affected by that dividend decision because the dividends are paid out of after-tax dollars. The goal of the financial manager of the firm should be to maximize shareholders' wealth or the stock price of the firm. Hopefully they'll make good decisions that will cause investors to be willing to pay a higher price for the stock of the firm. The primary function of a financial market, which would include all kinds of entities from individual investors to institutional investors, banks, insurance companies, mutual funds, and so on, brokerage houses and investment bankers. The main function of a financial market is to allocate the supply of savings from the households who have saved and want to invest, and it will transfer those savings to the demanders, who are the businesses who wish to expand, to build new factories, buy new equipment, purchase additional inventory. So they will finance themselves by issuing securities, and those households invest in those securities. So the financial market transfers savings from the households to the businesses, from those who have savings to those who need the savings or the capital from the financial markets. A few definitions, certainly not all the definitions presented in the chapter, but a few to which you should pay special attention are the primary market, where newly issued securities are sold for the first time. They go from the issuer to the investor, and there's only one primary market transaction for a given security. After that, the security will trade in the secondary market. It's a previously issued security at that point, and it transfers from investor to investor. As we mentioned in the lecture, the issuing firm could actually go to the secondary market to buy its own stock back, but typically the issuer is only involved in the primary market when the new stock is issued, and then it's primarily investors trading in the secondary market. An auction market is where brokers coordinate the transactions between buyer and seller. They just represent the buyer and seller and bring them together, as opposed to a dealer market where the dealer is actually buying or selling the securities. So we say the dealer is on one side or the other of a transaction in this over-the-counter market. You're either selling to a dealer or buying from a dealer in the dealer or the over-the-counter market. In Chapter 1, we learned that a corporation has some disadvantages, but potentially a lot of advantages. That may explain why most large companies that are household names are corporations. They have the ability to issue stock to many investors, and the investors have the limited liability, so they're willing to purchase stock in a company knowing that they will not have day-to-day influence on the operations of that company. So corporations are very important for companies to be able to raise capital through issuing stock, to have a lot of different owners, to provide owners with limited liability, and to give owners an ability to transfer their ownership. We also saw that the goal of the financial manager is to maximize shareholder wealth. That's measured by the stock price. So one of their goals is to maximize the stock price or to help maximize the wealth of the shareholders. The financial manager works for the shareholders. They want to get their stock price to be as high as they can. The third thing we learned in Chapter 1 was that financial markets exist to transfer savings from those who have it, who are households, to those who need it, who are businesses who wish to expand and need to grow their business. There's a lot of participants we talked about, such as brokers and dealers in the primary and secondary market, investment bankers, and things like that. So be sure to review all those terms and definitions and to keep the three major learning outcome statements in mind when you restudy Chapter 1 for the exam. Now that you've completed the Chapter 1 lecture, you should complete the supplemental homework practice problems at the end of the chapter in the course notes. The solutions are on iTunes U, or the answers are in the PowerPoint file posted to Blackboard, so check your answers one of those ways. You should complete the percent, decimal, and exponent review at the end of the chapter in your course notes. You should attempt the Connect assignment that is posted to Blackboard. That covers the Chapter 1 material, and then you should do the online Connect assignment through our Fin 380 Connect website. The syllabus tells you which chapters are covered and the due date of that assignment, and then we will go over the answers to that Connect assignment in class as scheduled, and you'll be able to ask questions about the Connect assignment during the scheduled class session. You should bring the Connect assignment that we've posted to Blackboard, and that is what we will use for our discussion in class, because your actual Connect assignment will differ from the assignments of other students in the class. So if you'll print off the one that's posted to Blackboard for this particular chapter, then we can discuss the same assignment. And then if you want us to look at your particular Connect assignment, you might print it out or bring your laptop and you can access it, and we can address specific questions you might have about your specific assignment. You should begin preparing for the exam early. Make your formula sheet as you study each chapter. Begin putting that together. And remember, after the Connect assignments are due, we repost them for additional practice, so you may work those multiple times, and the numbers tend to be different every time you work it, so you can get additional practice by working those Connect assignments for practice even after they are due.